What a day it turned out to be, with a 50 bips cut and an outsized bet at that from the Fed. The world markets rejoiced, but we were the global underperformers. While we started off with a 0.5% sort of uptake, and then from there petered down pretty much to close around the low point of the day. It was not just really about the benchmarks, the bigger profit taking, and that we will only know in the hindsight. What actually transpired with the broader markets, for our markets, that is what the pain point was. Some of the very high and mighty defense names are the ones which did see quite a bit of sell-off in trade yesterday. Having said that, the global party really continues. The Dow once again has managed to close in 500 points higher. In fact, the Fed cheer clearly continues, at least for the global markets, Nikunj.
So, Asha, what are we starting with? We are starting with a 2% uptick on NASDAQ, 1.5% plus uptick on S&P, and strong US labor data. So, and then the tailwind of the rate cut. If you put everything together, you would say that why did India underperform yesterday? And what does that mean for us? And are we looking at two parallel markets per se, where markets in a sense are the large cap stocks because of the global setup they are holding on, and the mid cap stocks largely because of local pressure that's caving in? I think that's the point which we need to address. But if I look at the market setup clearly is a proof of the fact that now we have decisively moved into a low interest rate regime. And when you are moving into a low interest rate regime, in the near term, it will have an impact on all assets. So the upside in the market may not be great because markets somehow are pricing this, but the downside in the market also gets rather comfortable. So the trade now is long emerging market, long metals, money will move out, and I think that trade is clearly visible.
Oh, yes, indeed it is. And it's a firm start as well to the global markets this morning. But just recapping how we shaped up in trade yesterday, you did have a flat close after we conquered that level of 25,600. And I have to say it's a very polarized sort of a market. While you did have the frontliners prove their might, record high levels as we held out around the 25,400 mark, it was very different when it came to the broader end of the market. 3 straight days on the trot that you're seeing the pressure building in, and it's not just mild cuts. The small cap index was down in excess of 1%, mid cap index 400 points, and in terms of the individual sectors, you had the PSU banks that continued to struggle in trade. Defensives like FMCG managed to hold out, and there was the Supreme Court setback for telcos, so that was a bit of a weak pocket. But Nikunj, how are you looking at that sort of dichotomy between the frontliners and the broader markets?
So I think it may well continue for some more time. And the reason why it may well continue to some more time, because irrespective of what is happening in the market, irrespective of what is happening in the world, I guess the small and mid-cap stocks, they had almost become Humpty Dumpty. And once you reach a size of Humpty Dumpty, the correction was due. And the correction could coincide with the shift from small cap to mid cap or mid cap to large cap. But I think the correction, it's severe in some pockets, which we'll talk about, I think was overdue. And I think that in the near term, that positioning may well just continue for some more time, because the excesses in the market, even after yesterday's fall or last week numbness, I don't think this market can really be called as something which is very attractive in the small and the mid cap space. Suddenly the zing in the SME market is out. Suddenly the small and mid cap stocks, which were the real cheerleaders, they are taking a back seat. So I would call the current leg of correction in small and mid cap stocks more like a overdue cyclical correction, which may just extend itself for some more time, both in terms of time and both in terms of price. What you don't want to do right now, while you don't want to get trapped in a sense buying some of these stocks, let the dust settle down in small and mid cap stocks, and this market will give you great entry points. If one really looks at the valuation check right now, that's the valuation check right now for you. 17 times is the 5-year average, 22 times is where they're trading right now. If you built in the India premium and the liquidity premium also, that clearly means that a 5 to 10% correction in some of the ranked mid-cap stocks cannot be ruled out.
Oh yeah, absolutely. Absolutely. And, I think more excruciating if you look at how PSUs have actually panned out and the kind of fall that they've had from the 52-week highs. I mean, celebrated names like Cochin Shipyard are down 44%, Bharat Dynamics 38% of a knockoff, MRPL down 36%, Hutco down 35%. Even some of the banking names like a UCO Bank is down about 33% from its 52-week peak. And, Mazgaon Dock is down 31%, IRFC is down 32%, and even some of the large and mighty ones, Likunj, for instance, SBI down 13% from the 52-week peak, LIC down 18%, ONGC down 17%, HAL down 25%, and IOC also has fallen about 16%.
So, Aisha, the correction I think is something very brutal, and these entire PSU basket in a sense really has been the cheerleader of this market in terms of where the market where the market leadership was. While in general the selling has been quite brutal, I think the valuations, at least in defense, railways and some of the defense, railways and shipyard companies are still looking stretched. I think we are reaching that point where another 5, 10, 15% plus suddenly these stocks will start looking attractive. We were very clear as a channel 2-3 months ago that these stocks were trading way above their fair value, and when anything trades way above their fair value, that mean reversion I think was due. I have always been a big votary that market will always follow markets mean revision will always happen, so I'm not at all surprised. I think now what you may see is that you may see divergence, which is that PSU banks have scope to outperform. PSU metals, given that interest rate cuts have come in, I think they will bounce back the first. I'm not so sure about railways. I'm not so sure about shipyard, but I think selectively defense stocks will also start making a comeback because the order book is looking strong, and they are the ones where that's where I think margins are improving. So to just make it very simple, I think PSU stocks have corrected. The correction was overdue. The correction may just extend itself for some more time, but within that, once the correction settles down, I think PSU banks will be the first one to come back, followed by metals, where I think a trading bounce is due, followed by defense names.
If you like this video, then like, share and subscribe to ET Now.